Estimated principal and interest payments. When taking out a loan, such as a mortgage, the estimated principal and interest payment is the amount a borrower is required to pay each month toward repaying the loan. This payment consists of two main parts: the principal, which reduces the loan balance, and the interest, which is the cost of borrowing money. Understanding how this payment is calculated is essential for budgeting and financial planning. 1. Principal payment reduces the loan balance. The principal is the portion of the loan that a borrower repays to decrease the total outstanding balance. In the early stages of a loan, a smaller percentage of the monthly payment goes toward the principal, but over time, as the balance decreases, more of the payment is applied to reducing the loan amount. 2. Interest payment covers the cost of borrowing. Interest is the fee charged by the lender for borrowing money. It is calculated based on the outstanding loan balance and the interest rate. In the initial years of a loan, a significant portion of the payment goes toward interest, with a smaller amount applied to the principal. 3. How to calculate estimated principal and interest payments. To estimate the principal and interest, P and I payments, lenders use a loan amortization formula. Online mortgage calculators can simplify this calculation for borrowers. 4. Fixed rate versus adjustable rate loans, AFECT payments. A fixed rate loan keeps the same principal and interest payment for the entire loan term. However, an adjustable rate mortgage, ARM, may have a changing interest rate, meaning the monthly payment could fluctuate after an initial fixed period. 5. Other costs may be included in monthly mortgage payments. While the estimated principal and interest payment covers the loan repayments, borrowers should also consider additional costs such as property taxes, homeowners insurance, and possibly private mortgage insurance, PMI. These can be included in the total monthly mortgage payment but are separate from the principal and interest portion. 6th, loan term impacts monthly payments amount. The length of the loan term significantly affects the estimated principal and interest payments. A shorter loan term results in higher monthly payments but lower total interest paid. A longer loan term has lower monthly payments but higher total interest costs. Estimating the principal and interest payment helps borrowers understand their monthly financial obligations and plan for their mortgage payments effectively. By considering factors like loan term, interest rates, and additional costs, homeowners can make informed financial decisions. To see the best offers on mortgage loans in your state today, click on the link in the description below.